Imagine this. It's the year 2004. You wake up in a quiet suburban neighborhood, lawns trimmed, flags on porches. Your house is worth more today than it was yesterday, and you didn't lift a finger. You didn't build anything. You didn't invent anything. You didn't work overtime. But your net worth just went up. And everyone tells you the same thing. This is normal. This is how wealth works. Housing never goes down. Now imagine being told that not owning a home isn't just a bad decision, it's irresponsible. That renting is throwing money away. That if you don't buy now, you'll be priced out forever. This wasn't an accident. This belief was engineered. And by the time you realize it wasn't real, the system was already too big to stop. The new American dream, quietly rewritten. For most of American history, wealth came from production. You made things. You saved money. You invested carefully. Debt was dangerous, shameful even. Your grandparents didn't brag about borrowing money. They bragged about owning things outright. But something changed after the year 2000. Wages stopped growing. Manufacturing moved overseas. Good jobs disappeared, quietly, gradually. Yet Americans were told they were richer than ever. How? Because asset prices were rising. Stocks, homes, retirement accounts. You didn't need higher income anymore. You needed leverage. And no asset was more important than housing. Houses became ATMs. Before the 2000s, a house was shelter. By the mid-2000s, a house became a financial instrument. People stopped asking, can I afford this? They started asking, how much will it be worth next year? Banks encouraged this thinking. They told homeowners, you don't need savings. Your house is your savings. Just refinance. And people did. They pulled cash out to pay credit cards, buy cars, fund vacations, cover medical bills. Entire lifestyles were built on rising home prices. If prices went up, everything worked. If prices stalled, cracks appeared. If prices fell, the whole illusion collapsed. Why everyone believed the lie? This wasn't just greed. It was trust. People trusted. Banks, ratings agencies, economists, the government. Every authority figure repeated the same message. Housing is safe. Housing is stable. Housing is different. They even had charts. Charts showing that national home prices had never fallen before. What they didn't mention was why. Because modern mortgage finance, the kind that exploded in the 2000s, had never existed at this scale either. This was a new experiment, and the public was the test subject. The interest rate trap after the dot-com crash in 9/11s. The U.S. economy was fragile, so the Federal Reserve did what central banks do when panic hits. They cut interest rates. Cheap money flooded the system. Borrowing became easy. Saving became pointless. Why save at 2% when homes were rising at 10% a year? Money stopped feeling real. Debt felt harmless. And Wall Street saw something else entirely. An unlimited supply of borrowers. Lending standards quietly died. In the past, getting a mortgage was hard. You needed proof of income, stable employment, a down payment, good credit. By 2005, those rules were outdated. Banks introduced no-income loans, no documentation loans, adjustable rate mortgages, teaser interest rates, loans where borrowers didn't even understand what they signed. Some were told, you can refinance before the rate resets, but refinance only works if prices keep rising. That assumption was baked into the system. No rise equals no exit. The most dangerous belief of all, here's the belief that made everything possible. If something goes wrong, the system will catch it. Banks believe risk could be spread. Investors believe math could eliminate danger. Homebuyers believe prices would save them. Everyone believes someone else was holding the risk. But risk doesn't disappear. It just hides. And it was hiding in millions of mortgages that never should have existed. The illusion goes global. Ritvik Shukla, January 6, 2026, at 12:11 a.m. This wasn't just America. Foreign investors were desperate for safe returns. U.S. housing looked perfect. Stable country, strong legal system, trusted banks, money poured in from Europe, Asia pension funds, sovereign wealth funds. They weren't buying houses. They were buying promises tied to houses. And Wall Street was more than happy to sell them. Imagine this moment. Imagine signing a mortgage you barely understand. Imagine believing this is the smartest decision of your life. Imagine everyone around you doing the same thing. Now imagine the entire system depends on prices never falling, not slowing, not stagnating, never falling. That's not a market. That's a bomb. And in the next part, We're going inside the machine that turned that bomb into a global weapon. Not one that builds cars or phones, but one that builds financial products. The raw material isn't steel or silicon, it's debt. And by the mid-2000s, Wall Street had perfected the art of turning ordinary home loans into something that looked almost magical. The mortgage leaves the bank originally. Banks made money the boring way. They gave you a loan, you paid it back over 30 years. They earned interest slowly. That meant banks cared if you could repay. But in the early 2000s, that model changed. Banks realized they didn't need to keep the loan. They could sell it. Once a mortgage was signed, it was bundled, packaged, and shipped off to Wall Street, sometimes within days. The bank collected a fee. The risk moved on. And suddenly, loan quality didn't matter anymore. Volume did. The assembly line of debt, here's how the machine worked. Local lenders issued mortgages. Those mortgages were sold to investment banks. Investment banks bundled thousands together. They turned them into securities. Those securities were sold to investors worldwide. In theory, it spread risk. In practice, it erased accountability. No one along the chain needed the borrower to succeed. They just needed the deal to close. Mortgage-backed securities, MBS. The first product was the mortgage-backed security. Imagine 1,000 mortgages pooled together. Some borrowers are strong. Some are risky. Some will fail. But as long as most pay, the investment looks stable. At least on paper. These securities paid regular income, like bonds, but with higher yields. To investors starving for returns, they looked perfect. Then came the alchemy. Wall Street didn't stop there. They asked a dangerous question. What if we take the risky pieces and repackage them? That's how collateralized debt obligations, CDOs, were born. The weakest mortgages were sliced, layered, and rearranged. Risk was mathematically redistributed, and somehow garbage became gold. Ratings agencies, the stamp of trust, here's where everything breaks. 3 companies held enormous power. Moody's, Standard & Poor's. Fitch, their job was to rate these securities. AAA meant almost risk-free. Government bonds safe. And unbelievably, they gave AAA ratings to products filled with subprime loans. Why? Because they were paid by the very banks issuing them. Conflict of interest wasn't a bug. It was the business model. The illusion of safety. Investors didn't analyze mortgages. They trusted ratings. Pension funds bought them. Insurance companies bought them. Foreign governments bought them. Many were legally required to buy only AAA assets. No one looked inside. No one asked what happened if housing fell nationally. Something models assumed was impossible. Credit default swaps. Insurance that wasn't insurance. Then came the final layer. Credit default swaps. CDS. They were marketed as insurance. You paid a fee. If the bond failed, you were protected. But unlike real insurance, no reserves were required. Anyone could buy them. You didn't even need to own the bond. This allowed people to bet on failure, and bets stacked on bets. The system became massively leveraged. The collapse didn't start with panic. It started with silence. No headlines, no emergency meetings on TV, no dramatic crashes. Just a few homeowners, missing payments, and one single mortgage default echoed through dozens of balance sheets. This all happened in what's called the shadow banking system, mostly outside traditional regulation. Investment banks weren't treated like regular banks. They borrowed short-term and lent long-term, using extreme leverage. Some firms were leveraged 30-1. That means a tiny 3% drop in the value of their assets would make them insolvent. But as long as prices kept rising, nobody seemed to care. Imagine a machine so complex that no single person understands it. Inside this machine, everyone believes risk is managed, losses are contained, and math has eliminated all uncertainty. Now, imagine one small failure. Just one. The entire structure depends on trust. Because once that trust disappears, liquidity vanishes. And when liquidity disappears, the machine stops. By early 2006, something changed. Housing prices didn't fall. They just stopped rising. In a system built on the assumption of constant growth, that was enough. Adjustable rate mortgages began to reset. Those low teaser rates expired, and monthly payments jumped, sometimes by 40 or 60% overnight. Borrowers who were told they could just refinance discovered a huge problem. Refinancing requires equity, and equity only exists if house prices rise. Defaults became contagious. At first, they were isolated. Then they clustered. Then they became systemic. Subprime borrowers were hit first, as you'd expect. But soon, so-called prime borrowers followed people with good credit who had simply taken on too much debt. Foreclosures increased. The inventory of homes for sale shot up. Prices began to fall. And once prices started falling, the exit door slammed shut. This created a feedback loop from hell. Prices fall, which makes refinancing impossible. That leads to more defaults, which puts more homes on the market, which pushes prices down even further. Every step reinforced the next end. Remember, these mortgages weren't just sitting quietly on bank balance sheets. They were embedded everywhere, in complex financial products sold all over the world. By mid-2007, Wall Street started to notice. Hedge funds began reporting massive losses. 2 of Bear Stearns' hedge funds collapsed entirely. Inside the financial world, people finally started asking the question no one wanted to hear. What are these mortgage assets actually worth? The scary answer? Nobody knew. Because once confidence disappeared, the buyers disappeared. Markets for these securities just froze. Modern finance runs on liquidity. It's the invisible lifeline. You don't necessarily need to sell your assets. You just need to know you can sell them if you have to. But suddenly, no one wanted mortgage-backed securities, not even the ones with AAA rating. Their prices weren't just falling, they were vanishing. And firms that relied on short-term borrowing to fund their long-term bets couldn't roll over their debt. They were solvent one day, illiquid the next, and dead the day after. Bear Stearns wasn't a small firm. It had survived for 85 years, through depressions and wars. But in March 2008, its counterparties stopped trusting it. Its funding evaporated almost overnight. The Federal Reserve had to step in, arranging a fire sale to J.P. Morgan for just $2 a share. A year earlier, it had been trading at $170. The message was crystal clear. No one was safe. You'd think that would be a wake-up call, but what followed was the summer of denial. Leaders and executives kept saying, the worst is over. It wasn't. The real losses were still hidden on balance sheets that were basically fiction. Everyone was just hoping confidence would magically return. It didn't. Then came Lehman Brothers in September 2008. Lehman was bigger, more connected, and even more fragile than Bear Stearns. As it started to wobble, everyone waited for another rescue. But this time, the government didn't step in. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest in U.S. history, and that single event shattered what little trust was left in the global financial system. The world froze. Money markets broke. Interbank lending stopped. Banks didn't even trust other banks enough to lend to them overnight. ATMs were being quietly monitored to see if a bank run was starting. Corporations couldn't get the short-term loans needed to make payroll. The credit that greases global trade disappeared. Planes, ships, supply chains, all of it depended on financing that no longer existed. The global economy seized up, but there was another, even bigger bomb ticking. Aggie, the insurance giant, was considered too big to fail. It had sold hundreds of billions of dollars in a type of insurance called credit default swaps. These were basically bets that mortgage bonds wouldn't fail. When those bonds collapsed, AGE couldn't pay. If AIG went down, it would have triggered a domino effect, taking down every major bank it had insured. So the government intervened with a massive $182 billion bailout. This wasn't to save AIG, it was to save the entire system from itself. Imagine waking up to that reality. Banks are closed. The stock market is in a free fall. Your retirement account is collapsing. Imagine realizing your savings, your job, your entire future, all depended on institutions that had just admitted they didn't even understand their own risks. This wasn't just a financial crash. It was a collapse of belief. And the damage didn't end in 2008. It was only just beginning. When the panic peaked, governments faced a choice no democracy ever wants to admit out loud. Let the entire system fail, or save it by breaking every rule they claim to believe in. They chose the second option. Within weeks, governments deployed trillions of dollars. Not millions, not billions, trillions. Banks were injected with capital. Guarantees were issued. Bad assets were quietly absorbed onto public balance sheets. In the U.S., this was called TARP, the Troubled Asset Relief Program. Officially, it was to stabilize the economy. Unofficially, it sent a clear message. If you are large enough, the rules do not apply to you. But who didn't get saved? Homeowners. They didn't get bailouts. Millions lost their homes as foreclosures swept through entire neighborhoods. People who had done everything right, they had stable jobs, decent credit, were wiped out by collapsing home prices and frozen credit. Unemployment surged. Savings evaporated. Retirement accounts were cut in half. For years after, wages stagnated while the prices of assets recovered, and that was not a coincidence. This is the uncomfortable truth. Losses were socialized while profits had been privatized. The system was structured to save banks first, markets second, and people last. Stock markets rebounded relatively quickly. The housing market did not. For millions of families, their biggest asset became a decade-long liability. The crisis didn't just destroy money, it destroyed trust. Trust in banks, trust in governments, trust in the experts and the economic stories we were told. People were told this was unpredictable, a black swan event. But millions could now see that it wasn't. The rules of the game had been written to protect the institutions, not the individuals. In response, governments promised reform. In the U.S., the Dodd-Frank Act was passed. On paper, it meant more oversight, higher capital requirements for banks, and new stress tests. But in reality, the financial system just grew more complex. Lobbying intensified, and risk didn't disappear. It just migrated to different, less regulated corners of the market. The system learned how to survive regulation, not how to become safer. And here's the great paradox. After the crisis, the biggest banks became even larger. A wave of forced mergers reduced competition and increased concentration. The very institutions that nearly collapsed the global economy emerged from the wreckage more powerful than ever before. They were now explicitly, not just implicitly, backed by governments. The concept of moral hazard became official policy. To prevent another collapse, central banks completely rewrote the rules of monetary policy. Interest rates were pushed to zero. Printing money, under the name quantitative easing, became normal. This flooded the markets with cheap liquidity, causing asset prices to soar. Stocks, real estate, bonds, everything went up. But wages, they lagged far behind. Wealth inequality exploded. This created the new normal we live in today. A world where asset owners get richer while renters fall behind. A world where debt has replaced real income growth for many. In a world where crises are managed with constant intervention, not actually prevented. The 2008 crisis didn't really end. It was just absorbed by the system, and its consequences became permanent and structural. Imagine being born after 2008. You inherit a world with higher asset prices, more debt, and fewer safety nets. Every major crisis we see today, from tech bubbles and housing prices soaring out of reach, to explosive debt and currency stress, it all traces back to a single year. 2008, the emergency tools used to fix that crisis. They were never put away. They became permanent fixtures of our economy. But when you make something permanent, you also make it fragile. Imagine a system so massive that everyone believes it cannot fail, simply because its collapse would destroy everything. Now, imagine that very system failing anyway. Not with a bang, but with a whisper. Quietly, slowly, and then all at once. That's what 2008 was. It wasn't just an accident. It was a warning shot. A glimpse into the cracks of the foundation we all stand on. And the echoes of that warning are getting louder every single day.